As expected, the Federal Reserve raised rates. Interesting, though, was the Fed's new dot plan that is signaling 3 rate rises in 2017, 3 in 2018, and another 3 in 2019. We're joined now by James Stanley from DailyFX. James, thanks very much for joining us. What does this outlook mean for the markets over the next few months?
Continued divergence. It looks at this point like dollar strength is rather relentless. It's difficult to imagine the backdrop with which this could reverse, because primarily we're seeing a theme of the U.S. against the world. The Federal Reserve is one of the few central banks that's actually looking at tighter policy options. We got confirmation of that yesterday. We even saw the Fed get a little bit more bullish and increasing that expectation for 2017, 2018. So there's not many other economies that are looking at tighter policy options. This can expose further strength into the dollar that eventually could become a bit of a hindrance to the continued recovery in the United States. We saw Ms. Yellen talk about this last January. So last December, we saw the first rate hike, 9 years. The Fed also expected to hike rates 4 times in 2016. Of course, that didn't work. We just got our first. But Ms. Yellen had commented after that hike last December to the effect that dollar strength unchecked could create an issue in the U.S. economy, primarily for exporters, thereby threatening any semblance of recovery that was seen at the time. Now, we have maybe even more dovishness from some of these global central banks. We've just seen the ECB go for another throw of QE. The British pound, of course, has been driven lower from dovish BOE around Brexit. The yen weakening massively on the implication that maybe we're going to see something from the Bank of Japan. There's not really a lot of other currencies that are begging for bids right now. The dollar kind of stands alone. So I think we're going to see that continue for a while.
Now, Yellen was asked about the Dow at 20,000, and her response was that valuations remain within what she called normal ranges. Do you believe it is?
Valuation is relative, right? So first and foremost, I'm not going to sit here and call Ms. Yellen a liar or say that she's wrong. I have a lot of respect for Chair Yellen. But normal is a very relative term. If we look at valuations on the S&P 500 right now, they are elevated by historical standards. Right now, the Shiller PE ratio on the S&P 500 is 27.86 on market open today. Historically, that's a pretty elevated level. Black Tuesday, 1929, Shiller PE was at 30. Of course, we saw a crash right after that. SNL in 1987, Shiller PE was only at 17, and then we saw a crash. Financial collapse, 2008, that Shiller PE ratio got up to 27.5 and then collapse. There's one other instance, historically speaking, where we saw that Shiller PE ratio get over 30, and that was in 1999, December 1999 to be exact. That led into the tech bust. So historically speaking, we are at elevated valuations on the S&P 500. There's no denying that. It's in the stats. The bigger question is if that exorbitant valuation is going to amount to a spill. I don't think we're there yet. I think that we could certainly see some extension of this move. We could see valuations get maybe even a little bit more exorbitant. But eventually there is going to be a very real issue for markets to contend with. And that's the vexing proposition of exorbitant valuations in a rising rate environment. We're not there yet. Right now, we're still at the excitement stage. It looks like the U.S. is on the path to recovery. We have the prospect of fiscal stimulus. And we have a central bank that's still ready, willing, and able to stand by in the event of any cataclysmic types of scenarios. But as some of those facets begin to recede, I think the focus is going to get more squarely centered on valuations as we are in that rising rate environment. This is further confirmed yesterday by the Fed.
Now, we did see the dollar regain its footing after the decision. What are the key levels we should be watching for in regards to the dollar as we head into 2017?
So that's a good question. 101.80 was a huge level. This was a big Fibonacci retracement. It had helped set some near-term resistance. But we're at 14-year highs. So I don't really have any recent historical levels that I could look to and say, well, yeah, that's been resistance, so it may come in again. We're at about 103 on DXY as a representation of the dollar right now. 105, maybe? You know, it's about another 2% up. That could be a very novel idea to look for an element of resistance. We had a quick swing low there in 2002. It's a psychological level, so maybe we see a little bit of selling come in around there. Big picture, I don't have another level until 109.15, which is quite a ways from where we're at right now. There's a Fibonacci level that's there, and if we hit that move, then we're going to be pretty extended. It's going to be a little bit overbought. But at this stage, I don't want to question the trend. I mean, this thing's bubbling higher. There's a reason for it. At this point, I want to look for ways to buy dips. So if that prior resistance at 101.80 come into support, then it becomes pretty attractive for topside continuation thesis.
Bearing in mind the central bank policies around the world, which is the cross that looks the most interesting to you at the moment?
Well, another good question. I don't know that necessarily crosses are most attractive now as opposed to majors. Dollar pairs against currencies that are probably going to be backed by relatively dovish central banks. I mean, dollar yen, I think that's one of the reasons we're seeing so many fireworks take place in that pair right now. So, on that thesis, I like the idea of continued short positions against the yen. The bigger question then comes, how do you want to sell the yen? Personally, I like the idea of a long pound yen set, primarily from the vantage point that we are still seeing a little bit of the Brexit sell-off or trace. There could be some additional strength as inflationary pressure in the UK may be seeing a little bit more of an uptick in the coming quarters, years. That sharp repricing around Brexit, I don't think that we've seen that completely filter in the inflation numbers yet. It's still very early, right? But exporters into the UK economy are going to be feeling this pinch in coming quarters as they report earnings. And this is the area where they'll look at price increases. I mean, we've already seen this on a variety of products throughout the UK economy, and it's likely going to continue as a trend. And if we get those rising inflationary forces, the BOE is going to be in a very, very difficult position. They're not going to be able to continue to, push this dovish policy into markets if we are seeing, 2.5, 3, maybe even 4 points of inflation in the years. So, from my perspective, I like the idea of looking for some continued strength in the British pound if I had to get away from the US dollar. The one thing that I'm pretty certain of is that I want to look for ways to continue selling the yen.
Of course, President-elect Trump remains the big unknown. Yellen did say that the Fed had discussed Trump's economic plans. With such an unknown, do you think the changes to their economic forecasts are realistic?
That's the million-dollar question. So there's a lot of, I guess we say animosity between the Federal Reserve and markets, particularly around that topic of the dot plot matrix. I don't know that anybody really takes it as, a mission statement at this point. It's more of an idea, a hope, maybe even, if you will. But I don't think that we're at the stage where people are going to take the Fed's projections as dogma. I don't think they're going to, base their entire analytical skill set off of these Fed projections that have historically been pretty wrong. It goes back to that compendium of positive things happening all at the same time. We have a new president that presents change, right? We have the whole stimulus. We have a central bank ready, willing, and able to stand by. And U.S. economic data is improving. I think that's what's driving this move right now. I mean, we have maybe even some pseudo-euphoria around the situation that's just continuing to drive this thing higher. But, the reality of it is that as valuations get higher, the bar for continued gains gets more difficult to jump, right? And in a rising rate environment, we are going to see a pinch, inevitably. The question is, how aggressive is the Fed going to be with that rising rate environment to elicit that pinch? If Chair Yellen does it right, again, is one of those relative terms. I don't even know what right would be here. But if she does it right, I think yesterday was, in that direction, then I think that stock prices could remain relatively stable on the initial increases that we're seeing as we see this normalization cycle come in a little bit deeper. If the Fed goes too aggressive, everything could spill over. Very similar to what we had last December, right? Last December, the Fed, they hiked rates first time in 9 years, but they also said 4 hikes in 2017, 2016, 4 in 2017. So, we were looking at, a legitimate 200 basis points of tightening over the next 2 years. Spill over on that guidance. They continue to run higher. And in December, when they hiked rates, last December, they didn't increase that guidance. They kept it the same. So it was kind of like a dovish hike, right? Stability remained for about 2 weeks, but the open of the new year is when things really got started. And that's because we had these other forces like implosion in Chinese markets, oil prices continuing to get crushed. So you look at the backdrop, very threatening, risk aversion based, and that tightening cycle did not seem comfortable in any way at all. It was a little too aggressive. So the Fed backed down, and they spent much of the first half of the year being very dovish, much of the second half of the year being a little bit more hawkish, increasing that hawkishness as the S&P rose. And now we're at that point. They're ready to normalize. They're ready to get more hawkish. If they go too aggressively, we might see stock prices spill again, like we did last year. Might just be a little bit more of a timeline issue here, where it takes a little longer.
Well, thanks very much, James. James Stanley there from DailyFX in reaction to the Federal Reserve raising rates and what that could mean for the markets over the coming months.